So hi, everybody. Welcome to our nonprofit board training. This is our third in the three-part series. It'll be about an hour long today, January 19th. With me, if you want to flip the page, is Mahnaz Cavalluzzi. She'll be presenting part of this presentation along with me, Matthew Burke. That's who we are. So a bit of a background on us, if you're not familiar, which most of you probably are. We are an accounting firm, staff of nearly 65. It's probably closer to 70 these days. We have 8 partners, and we are built on a foundation that really serves nonprofit organizations and similar ones. So we like to say that between nonprofits, schools, which are either public or private, healthcare entities that work in the nonprofit sector, and otherwise, it's probably about 2/3 of all the work that we do as an accounting firm. So we're a bit strange that way, but it's strange in a good way for you all. So we have lots of nonprofit materials that we publish ourselves, including seminars and webinars like this. So I'm Matthew Burke. I'm a partner with Cerini. I've been here for about 20 years now. I've been a partner since 2011. I work with a lot of nonprofit organizations, probably about 100 on an annual basis. And most of what we do is in audit and related capacity. With me is Mahnaz Cavalluzzi. She's a key member of our audit team. She's a manager. She works with probably 50 or so nonprofits and schools and other types of organizations. So when we're talking to you as board members, it's with experience. You know, we've seen the issues that you face regularly. And I think most importantly, at the end of every audit that we perform, and we perform hundreds a year of nonprofits, we have a meeting with the boards of directors or the finance committee or the executive committee or audit committees where we go over issues that we encountered during the audit. We go over some financial trends and things like that. So what we've encountered there is that nonprofit board members are not always well-versed in financial issues because they come from different walks of life. And so this webinar is intended to help educate board members about finances of nonprofit organizations, what they should be looking for in financial statements, ways they can benchmark their nonprofits, ways they can compare to other nonprofits, and really other companies to see if there's solid financial viability for the nonprofits that you're working with or working for. We get a lot of questions from non-financial minds about how to really understand what the heck is going on from a finance or even an accounting basis. So the purpose of this is really to cover those subjects. We initially, before we actually prepared our materials, had hoped to talk about fundraising as well. That's something that we're not probably going to get to today. We didn't really plan for that. As we prepared the financial slides, we realized that there's just so much content here, so much to get through, and we didn't want to really rush any part of it. So the fundraising aspects of this presentation that were planned will be covered in a later presentation at the end of this month that we'll talk about in literally the last page of this slide. So stay connected to us. We're always publishing good content for nonprofits, for boards, for finance committee members, audit committee members, and we can do a lot to help the sector as a whole, not just our clients. So the way we're going to format this is Mahnaz and I will be alternating pages. This way you're not just hearing one of us talk. There is a chat feature, there is a Q&A feature. We'll try to keep up with that as best as we can as we're sort of going through the materials. If we missed anything, feel free to reach out to us afterwards and we'll be happy to answer.
Good morning, everyone. As Matt mentioned, so we're going to start today's presentation with the financial analysis and trends. Really, the purpose is to go over ways you can look further into your financial statements and different calculations, ratios, trends, and some industry benchmarks you should be using when looking at your financial statements. So some of the different calculations we're going to go over today are liquidity measures, days in cash, days in receivables, debt to assets, trends in your net assets, expendable net assets, program trend analysis, fundraising event profitability, program service percentages, and budget to actual performance. So we'll spend a little bit of time talking about each of these topics today.
And it's important to note on that list, it's certainly not all inclusive and completely exhaustive. There's a lot more that can be delved into when you get to the finances of a nonprofit organization. We just want to give a nice overview of all of it and give you some takeaway points and talking points for when you are looking at information you're getting from your board, so you can ask smart questions and make sure you're fulfilling your fiduciary duties, really, ultimately. So the first set of measures that we want to go through are liquidity. So liquidity, in a very general sense, measures the organization's ability to meet its financial needs. We say in the next fiscal year because that's the nature of the ratios and the calculations that we talk about. But really at the end of the day, when you're managing an organization or you're on the board, you want to make sure you're fiscally viable. You want to make sure that you can pay your bills on time. You want to make sure that you can pay your payroll on time. You want to make sure that you have rainy day funds for when things like COVID happen. right? Obviously, PPP loans came into play, and the CARES Act gave a lot of money to nonprofits that helped them out significantly. But before that, you didn't really know what was going to happen, right? So you needed to have liquid resources, and liquidity refers to cash flows and things like that, the ability to just pay your bills and have resources to tap into. So generally, there's two calculations that we use here. Sometimes you add in the quick ratio and things like that. So working capital is defined as current assets minus current liabilities. When you look at your statement of financial position, which is really your balance sheet, but for nonprofits, they call it a statement of financial position, your assets and liabilities should be classified as either current or non-current. So you may wonder what the heck the difference is between current and non-current. Current from an accounting sense, and sometimes accountants have different definitions of words in the English language than real people, but current really refers to an asset converting to cash or a liability to be settled with cash within 1 year. Typical current assets include cash. Obviously, you can use that whenever you need. Accounts receivable, grants receivable, pledges receivable that are due within a year. So any amounts that are owed to you for services you provided or donations that have been committed to that will be collected within 1 year, those are considered current assets. You may have prepaid expenses, insurance and rent and things like that you paid for in advance of the bill being due. That will be relieved within 1 year also. And then on the current liability side, you have your general vendors payable, your accounts payable, amounts that you owe to different individuals in terms of payroll, maybe bonuses, commissions, things like that, if you have such a thing. Typically on the current liability side, you also have lines of credit. Lines of credit are typically due on demand, but sometimes they're termed out. So in your current liabilities, you'd have the current portion of amounts that are due of your current debt. Mortgages payable, if you have mortgages or long-term debt, the amount due within 1 year would be considered current on your financial statements. So that's something to look out for when you're looking at your financial statements. What's current, what's non-current. I know I'm diverting a little bit off the path here, but if you have financial statements that don't classify between current and non-current, you should talk to whoever's preparing those financial statements, whether it's management internally or your auditors. You want to have that classified presentation, as we call it, where you see the current versus non-current, because it's more useful information there. So you can perform these calculations that we're about to talk about. So working capital, like I said, it's current assets minus current liabilities. Generally speaking, that should indicate whether or not you have enough cash flows coming in the year from your current assets to pay your current liabilities within the next year. Obviously, you want to have a positive number there. If you don't, it shows that you're going to have to tap into additional resources that you don't currently have to pay your bills within the next year. Your current ratio is your current assets divided by your current liabilities. If you think about the math of it, a working capital of 0 would equate to a current ratio of 1 to 1. So you want to have a current ratio of at least 1 to 1 to mean you can get through the next year without tapping into those resources. But ideally, you want to be higher than that. You want to have positive working capital. You want to have cash flows. You want to have money sitting in the bank, maybe investments sitting in a brokerage house. And you want to have all of that in excess of the current liabilities that you're going to have. Current ratio of 1 to 1 is really just getting by the skin of your teeth. You want to have a current ratio probably of at least 1.25 to 1.5 to 1, if not higher. This way you have that cushion. And the reason you need a cushion is most organizations have a significant receivables balance, usually from grantors, from federal or state or local agencies that owe them money, sometimes from donors. And receivables, you can't always predict exactly when you're going to have those collections, right? So you want to convert receivables to cash as quickly as possible, but it's not always under your control. That's why you need these other resources. And that's why you need a current ratio of more than just 1 to 1. Because if it's just 1 to 1, you're going to have times where you have cash crunches during the year, where you maybe can't pay your vendors within a month, where maybe you're having fire drills to make payroll on a biweekly basis or something like that. So obviously this just speaks to the need to have cash on hand, have liquid resources on hand so that you can, help smooth out funding difficulties that may come during the course of time. Quick ratio is another calculation. This is taking the current term and shrinking it down to 90 days instead of 365 days. So it's your current assets convertible to cash within 90 days, not a full year, divided by current liabilities. So that's something to keep in mind too. Within 90 days, it would be cash, investments that are readily liquidable, and receivables that would turn over within 90 days. So really the whole point of this is to ask yourselves as board members and then management of the organizations whose boards you sit on, does the organization have the resources to meet its current obligations with the current assets it has available? And now Matt as well elaborate on what I just said for sure.
So looking further into these liquidity calculations, Matt kind of mentioned it, but we'll go into it a little bit more where you really want to be with these calculations. So the first, your current ratio, again, that's your current assets divided by your current liabilities. You want to be at 1.5 to 1. That would be a positive indicator. It shows a healthy organization. So like we said, a 1-to-1 ratio would mean you have exactly enough current assets to meet your current liabilities as they're coming due. You want to be a little bit higher than that. Where this matters is if you're looking at a line of credit or other debt, banks are going to be looking at your financial statements. They want to know that you're going to be able to pay them. So typically they're looking for a current ratio of at least 1.5 to 1. And that just means that you're going to be able to meet your financial obligations over the course of the next year, that you're a bankable organization and you're generally healthy and don't experience cash flow problems throughout the year. So a current ratio less than 1-to-1 or negative working capital, which would mean that your current liabilities outweigh your current assets, are worrisome to your funding sources, to donors, to banks, to anybody that's looking at your financial statements. It definitely sparks questions about the organization's plans for the future. How do you intend to meet those obligations as they're coming due? Maybe you need to lean on a line of credit, or you're going to have to be bringing in some other sources of funding or revenue to really meet those obligations. So again, a quick ratio looks at your current assets that are coming due within 90 days, so your cash, your investments, and your receivables that are going to be expected to be received within 90 days. And a quick ratio of 1-to-1 is generally considered positive. So the ratio there is a little bit smaller than with your current ratio because it's a shorter time span. So if you're able to make it at a 1-to-1 for the 90-day period, that's a healthy organization. So as the board or management, you really want to be paying attention to these ratios. You want to make sure that when you're looking at the information, it's timely. So when you're looking at your financial statements, it's as of a certain date in time. So if you have a June 30th year end or a 12/31 year end, you're looking at your current assets and current liabilities as of that date. Management and the board, you're going to be most aware of what happened after that date. So if you need to be looking at updated numbers to perform these calculations, you should be doing so. Maybe you had a significant amount of receivables that came in, or other revenue that was earned, your cash balances fluctuated. So you definitely want to be paying attention to those numbers and how they change over time and how these ratios are impacted by those changes.
Another useful measure of liquidity, really, and financial viability and financial resources is days in cash. So theoretically speaking, the point of days in cash is to calculate the number of days of operations the organization can sustain with its then current cash balance as of whatever date you choose. Usually it's a year-end date. When we make our presentations, it's an annual audit. So it's always the last day of the year that we're talking about. And that assumes a daily cash burn rate. So the burn rates, again, in quotes, I'm using air quotes a lot today. They're calculated as dividing the total expected cash expenses for the organization by 365 days. So how much do you spend on a daily basis is really the moral of the story there. If you want to be really technical about it, the way you can calculate that is look at your statement of functional expenses, which breaks out your expenses by functional category, how much is programs versus administration versus fundraising. And then on the other hand, it shows a natural classification of your expenses: salaries, rent, utilities, supplies, and so on. So that schedule that goes with your audited financial statements and should be prepared internally, you have to carve out what's non-cash from that. So non-cash expenses are things like depreciation, weird amortization, maybe bad debts, and some other one-time items. To determine what your total expenses on a normal operating basis are, divide that by 365 days. You may want to use budgeted cash expenses for the future year. That would be a smart way to do it too, to determine how much you plan on spending in the next 365 days. So the whole point of that is take that daily cash burn rate and put it underneath your cash balance. And that tells you how many days of cash you have on hand as of that date. So this provides quick insight into how liquid you are. So we were talking about liquidity measures, working capital, current ratio, quick ratio, as Mahnaz went through, what you should benchmark there. Days in cash is another way of looking at this because cash is king, as they say. Right, you can pay anything you need to with your cash balance. Everything else, it takes some time. Receivables, you have to wait till you get the collections to be able to liquidate those. Investments, you have to maybe make some trades, or there's some delay there, wait for things to settle, cash to hit your account. Cash, if you need it today, you have it today, you can pay your bills on time. So it's a very quick insight into whether or not you're having cash flow issues. Cash flow issues are different than liquidity issues, right? Because you may have a ton of receivables on hand and no cash. You can't pay your bills with receivables, right? You can't pay your employees with receivables. You pay them with cash. So that's why we look at this separate from and really next to the liquidity measures that we just talked about. So an appropriate amount of days in cash, if you're looking to benchmark, it's not necessarily an easy cut and dry number. It really depends on the type of organization. And we work with so many different types of organizations. If you're in the mental health field, for instance, your receivables may come in a little bit quicker. If you have grants with hospitals and things like that, it may take longer. If you're dealing with the federal government in New York City, your receivables get collected very slowly at times, right? If you're mostly privately funded, you might not have cash flow issues at all. Because you don't really have receivables, you're just getting donations, but there you might have issues raising the money every year. So it's hard to really answer this, but we like to say, generally speaking, broadly speaking, 60 to 90 days of cash on hand is an okay. I'd say the lowest bar of healthiness that you can have for days in cash. Obviously, the more, the merrier there. The higher it is, the better it is for your organization. But if you're getting by on, let's say, 15 days in cash, 15 days goes by very quickly, and you're paying your payroll probably every 15 days. So if you're in that position where you're under 30 days, I'd say, maybe under 60 days, you really want to understand what's going on there and how you plan to keep the business afloat. And remember, nonprofits are still businesses. In case, cash flow dries up, you need contingency plans. That's where lines of credit come into play. As Mahnaz mentioned, you need that banking relationship because sometimes you don't have enough cash to get through. So that's something to really keep in mind here. And this is one that we don't really see often, but we like to use a lot because I think it gives a really quick view into the cash flows of an organization, which is really, really very important. Something to keep in mind here too, you don't want to have, and I get this question a lot, we're not investment advisors, we're not attorneys, but we see these issues all the time. How much cash is too much cash? It seems like a silly question, but it's really not. Because at a certain point, you're sitting on cash that's idle, maybe not earning interest, maybe not being invested. I would say it again differs by organization, but once you're in the 6 month to year range, you're probably good, right? So if you're sitting with 3 years of cash on hand and you're not putting that money to work in any way, shape, or form in, let's say, safe investments, fixed income securities, something like that, you should consider getting an investment policy, maybe an investment committee of the board, and looking to prudently invest those excess funds that you probably won't need to tap into. If you have no needs to use that cash down the line, if you're not investing in new programs or going on a hiring spree or have capital needs or anything like that, and you literally just have a lot of cash that you don't know what to do with, consider investing it. It's definitely permissible by law for nonprofits. It's just certain rules that you have to follow.
So now looking at your days in receivables. So receivables are the amounts that are owed to an organization for however you earn your income. So whether that's your services provided or if it's commitments made by donors or by other funding sources. So this could include your accounts receivable, pledges receivable, things like that. So the days in receivables calculates the average number of days it takes for an organization to actually collect those receivables. So this is going to vary by organization. Like Matt said, different funding sources pay differently. So generally, the fewer days, the better. So this is kind of the opposite of your days in cash, where a big number is better. Here, the fewer days, the better. It means that your cash is being collected more quickly. So typically what we would expect to see here is that the number of days should be no more than 45 to 60. It should kind of align with your days in cash, because if your days in receivable are higher, it means you're not collecting that cash as quickly to actually pay your bills on time. So you want, ideally, that number should decrease over time, or it should at least be remaining consistent based on your funding sources. So some of the organizations that work with government agencies might see this number be closer to 60 to 90 days, maybe even higher than that, depending on your funding sources, how they work. If you're sending in vouchers and waiting for approval and waiting to get payment. And on the flip side, if you're an organization that receives a lot of like private grants or foundation grants and contributions, you're not really going to have a high receivable balance at all, because that money just comes in. It's not something that you're really expecting to earn. or it's not something that might be considered a receivable. So it's important to think about your organization and how these numbers really relate or can be important to you. And whether or not you might need some financing to bridge that gap, like a line of credit or other sources of income or financing. So this type of ratio, days in receivable, is really more relevant to organizations that have like a regular revenue stream, fee for service organization or government contracts, as opposed to those that are receiving large contributions or private grants.
Sorry about that. So debt to assets is something we look at also to really look at how much debt you have on hand compared to the size of the organization and your assets and things like that. Debt is not necessarily a bad thing. Obviously, it's best to have no debt, but debt is very useful and you need it at times. And it's smart from a business standpoint at times to, enter into these debt arrangements as opposed to spending your own money and liquidating those cash resources. So we just got through saying on the liquidity slides and days in cash that it's important to have significant levels of cash to get through rainy days, to help invest in new programs down the line, to maybe consider mergers and acquisitions and things like that. So you don't always want to just spend your cash when you can finance something and stretch out a payment over a long period of time. You want to preserve that cash. So debt is okay to have. If you see debt on your balance sheet or on your statement of financial position, it's not inherently bad. If you see too much debt, though, it could create problems for the organization in terms of servicing that debt, meeting its obligations as they come due. It may create the need for refinancing arrangements. It may create the need for different banking relationships. Interest expense obviously can be a burden. So, how much debt is too much debt? So one way to look at that, and it's not a be all and end all, but debt to assets. So the calculation measures an organization's leverage, and if its debt levels may be excessive in proportion to its overall assets. It's calculated as total debt from your statement of financial position or balance sheet divided by your total assets. So what is debt? Debt is not accounts payable. Debt is not deferred revenue. So on your liabilities, you'll see these different captions. Accounts payable is amounts that you owe to vendors and service providers and things like that. It's not an obligation. It's not a legal, it's legal, but it's not a binding debt arrangement with a bank or a financial institution or lender or something like that. Deferred revenue is another liability you may see. That's really just collections on revenue stream that hasn't really happened yet. Services to be provided in the future. So the debts that you really want to capture when you calculate your debt to assets are things like we note below here. Lines of credit. So lines of credit are meant to smooth out operations, give you an available pool of money to tap into if you need it to pay for bills and things like that. There may be strings attached where you have to have a balance on the line of credit, a minimum balance. You may have to have a cleanup provision where you have to pay it down, at some point during the year. You may have to have activity. You can't just have it sit idly. Every bank and every line of credit is different, but that's certainly debt. That's amounts that you're borrowing, you're paying interest on, and you have to pay back. Mortgage payable is pretty self-explanatory. It's a secured debt, usually by a building or some other capital spend or something like that. And it's usually long-term in nature. We're seeing a lot of balloon type payments on nonprofit mortgages. So this is something to keep in mind now. We all know that interest rates have really kind of skyrocketed this year. It's debatable whether they're too high. I don't know, I'm not an economist, but it seems like they're only going higher too, for a little bit of time, at least for the rest of 2023. So that's something to keep in mind. If you have a mortgage payable with a balloon coming up, you're gonna have to refinance that, and an interest rate of 4% a few years ago might be 6 or 7 coming up. So that's something that has to be factored in, and another reason why you want to keep your debt at a reasonable level. Equipment loans, sometimes we see that organizations buy major equipment, whether it's computers, it could be vehicles, it could be software, anything like that, where you're financing that over 3 to 5 years instead of just buying it outright. It's meant, again, to spread the cash flow pain out over that period of time instead of taking it right away. And then we're seeing a lot of related party notes. Sometimes board members provide loans to organizations. This is usually for more financially distressed organizations that don't have access to lending otherwise. Nonprofits are not always easily bankable. A lot of banks don't deal with nonprofits altogether. I've been told by banks directly that they don't like working with nonprofits because their ultimate recourse is to take assets from nonprofits. So let's say you have a mortgage that you foreclose on. The bank doesn't want to be in the front line of the newspaper saying that they took the building away from XYZ nonprofit. It's bad press for them. So it's hard to get banking and lending for nonprofits, generally speaking. So when nonprofits can't get that, they turn to their boards, they turn to key members of management, they turn to other outside third parties. So that would be other notes payable. So really, when you sum up all these different types of debt, and these probably should account for 90% of the debts that any of your organizations would have, you know, a ratio of 1.25 to 1 is considered acceptable. Any amount less than that should be questioned. So that's the total net assets. I think the math on here is worded a little incorrectly. So you don't want to have debt of 1.25 times your actual total assets. It should be about 0.25. So I think that one should drop off, because you don't want to have too much leverage to the point where it's creating these significant interest payments and it's creating significant demands for cash at later points in time. So it all kind of ties back to the liquidity that we're talking about earlier. So the debt, you know, current payments go into the liquidity measures, long-term payments do not, but they come due when the balloons hit and the refinances have to happen.
So next, we're going to talk about some net asset measures. So net assets are your assets minus your liabilities. It's basically akin to equity of an organization if you're used to talking about for-profit organizations. So we'll talk about some of the trends we want to see in net assets and what expendable net assets are. So generally, you want to see your net assets increasing over time. You want to see kind of a steady increase rather than a one-time jump, because it shows really a continuous growth within the organization, more organic growth. And generally, that would mean better cash flow, better liquidity. Overall, it's a healthy organization. It's operating efficiently. Your programs are generating a profit that's increasing that net asset balance. And you know, your expenses are leveling out, basically. So one thing to consider when looking at your net assets is if depreciation is significant to the financial statements overall, if you have a high fixed asset balance, particularly if you have buildings that are being depreciated, could lead to a large depreciation expense. You may want to add that back to your overall change in net assets. So your change in net assets is really your net income, basically. So you may want to add that depreciation back to kind of normalize that number, since depreciation isn't really a cash outlay. It's an accounting change. It's really just an accounting concept. If you do have a building, probably that asset's value is actually increasing over time, but on your financial statements, it's shown as a decreasing value over time. So to get a more accurate number, it might make sense to really add that depreciation back in and see what your cash change in net assets is. Your expendable net assets is really any assets that are available for use by the organization. So like I mentioned, your net asset is calculated using your total assets. So that includes your property, plant, and equipment, your fixed assets, or prepaid expenses, or other assets that aren't really available for you to use and spend. So your expendable net assets would be anything that's available to be used that doesn't have any donor restriction associated with it, or any other assets such as fixed assets. So in looking at your expendable net assets, you take your net asset balance, you carve out those assets that aren't available to be used, and you want to be left with a positive number still. So that shows you have positive net assets that are able to be used as the management and the board sees fit. That's what's used to pay your bills over time. And that's really where you want to look to see what plans you have for the future, how you intend to use those net assets, if you do, or if you're really just holding them in reserve.
Okay, so program trends is something that I feel like is not often as looked at as the other measures that we just discussed. A lot of nonprofits operate in different fields or have different programs or grants or something like that under their general exempt purpose and what they do on a daily basis. So we find that organizations oftentimes have money losing programs without realizing it, or they may have money making programs, you know, that they don't really exactly realize. So to whatever extent you can try to get a granular view of your organization's programs and how much they may be bleeding or generating cash for the organization would be useful information. When you have that information, you can decide whether or not you should look to bolster programs somehow, make them more efficient, maybe restructure them, as a last resort, maybe even consider cutting them or talking to another organization that maybe is bigger that could take over your program that's losing money for you, but may fit into their structure better. So that's really the whole point of this. So it's really a significant measure of an organization's operating effectiveness based on its programs overall, the program trend analysis. You want to see if it's profitable, break even, or even operating at a loss. And you also want to look at trends over time. So a lot of this stuff, actually, you should look at trends over time. We've been mentioning the current ratios and the benchmarks to look for, but trend it out too. When we do our presentations at the end of audits, we usually trend at least 3 years, sometimes 4 or 5 years, to see what's going on. Now, what you'll notice the past 3 years, unfortunately, COVID really wreaked havoc on the normalcy of financial statements for organizations. So we're seeing a lot of variability, seeing a lot of programs decreasing in 2020 and 2021, coming back a bit in 2022. We're also seeing PPP loans and ERTC funds and other types of grants that came through the federal government passed down that helped certainly the 2020, 2021, and even 2022 balance sheets and financial statements of organizations, but it distorts the view of what a normal operation is. So you have to consider that as well. So the program trends are going to be a little bit harder to look at during the COVID times. Now that we're hopefully, knock on my wood desk, getting away from that forever, you should be able in 2022's numbers, and then definitely in 2023's get back to looking at a normal program. So you're really looking at program revenue less program expenses. So we're using the word program a lot, but it could be by funding source. It could be by grant. You may have a state contract or something like that that has 5 different programs or dollar amounts coming to you for that. So you want to look at all those different levels of granularity. You should avoid money losing programs if they can't otherwise be subsidized. So a lot of organizations that are government funded, they tend to not have as significant a level of funds coming from private sources. So a lot of government funds are really either deficit funded or reimbursable, where there's really no profitability there. It's basically you get reimbursed for what you spend, and they cover some sort of admin cost, but it's not always that high, maybe 10%, maybe 15%. But your organization may spend 20 or 25% on admin. So someone has to pick up that difference there. Looking at things on a programmatic level would show you that. It would show you that this organization is operating at a break even, but it's not meeting all our admin needs. So our donations or our fundraising events are paying for those admin needs. It's just a good way to look at everything and see where the money is coming from and really ultimately where it's going. So you can make smart decisions about, what you should do for your programs, how you should raise more funds, how much unrestricted funds you do need to raise, going into any given year. How much money do you need to bring in that isn't from your normal programs or operations, from donations? That's not a question that's always easily answered for organizations. You also want to look at concentrations of revenue. All too often, organizations are completely reliant on 1 or 2 funding sources or a very small pool of funding sources, and funding sources are subject to change, right? There may be change in leadership there may be budget cuts, there may be a redirection of, let's say, foundation dollars. If they're looking into a different area and just focusing their efforts and dollars on something different than what your organization does, that really puts you at risk. So if you have a heavy concentration, and generally speaking, we say a concentration is 10% of your total revenue coming from one specific place, whether it's a funding source or grant or whatever. You want to try to diversify as much as you reasonably can so that you eliminate that risk and you remove that potential significant losses. A lot of organizations earn revenue based on what we call units of service or some sort of program measure. I know, so you're doing X, Y, and Z at a certain rate and being paid for that. So you want to look at trends in units of service over time, or as your organization performing fewer and fewer services. This is something that hit a lot of our mental health clients during COVID, obviously, because they were shut down. They were closed. They switched to virtual, but the virtual didn't necessarily offset the losses in the in-person services that were provided. So you want to see that. You want to see if units of service are trending up or down, and kind of pair that with the revenue and expense from the program to see if there's any interesting trends there. So really determining revenue or expense per unit of service performed for those organizations that this applies to would be useful too. Again, trend it out, look at what's going on, try to understand if there's significant trends, and really try to assess how your different programs and business units, let's say, are functioning. If they're losing money, what can you do about it? If they're not losing money, great. And how much is subsidized by other sources, and what do those other sources need to contribute to keep the whole thing going?
So next we'll talk about fundraising events and how to measure your fundraising event profitability. So that would be measured by taking your total revenue raised less your total expenses associated with the events. So you want to include all of your direct costs and maybe some of your indirect costs as well. So there's obviously going to be the venue costs, food, things like that. But what amount of salaries was used to plan this event and, you know, undertake this event. So things like that you may not be considering, you want to make sure that you factor into your profitability. Looking at that will determine if the events are worth continuing or if maybe some changes need to be made to generate more income from each of your events. So one of the questions that I think we're asked very often is, what is a good benchmark here? So we say that a good rule of thumb is that events should generate at least 3 times the related direct expenses. That would help cover any of those sort of indirect expenses and still leave some profit left over for the organization to be using those unrestricted funds to help cover any other gaps in coverage. And again, you want to be looking at the trends in your fundraising to see if there's any sort of slippage. If you're noticing that your events are becoming less profitable or there are fewer attendees, you might want to change your approach, who you're targeting for your events, create new and exciting events to differentiate yourself from other nonprofits. We typically see the same events over and over, a casino night, a gala, things like that. So what can you do that's different than all of the other nonprofits that's going to be exciting to people, bring a new pool of donors in, separate your organization from others, and really be attractive to people. A lot of donors are bored by those same ordinary events. So that's something you definitely want to consider. That's a way to kind of revive your fundraising events and bring in more awareness to your cause really overall. So I think that, again, if you're starting to see those trends trend downward, this is something you want to look at over time and think about when you had your golf outing. Was it bad weather that day? Is that what caused the event to not be as profitable? So you definitely want to be looking at things, take a step back and see what's kind of causing these trends and how you can change them going forward.
That's something else where COVID is going to screw up the comparison. So you might have to go back to like 2019 even for a normal year, but maybe things are so changed now that events aren't normal. Look at what we're doing. This is a webinar. 3 or 4 years ago, this probably would have been in person with streaming, right? So we definitely noticed that with fundraising events, a lot of organizations saved money and they were able to have more profitable events. Less dollars coming in gross, but more profitable because they're spending less on venues and food and all that other stuff. So keep that in mind too. When you're doing comparisons over the past few years, there's going to be some wackiness in there because COVID really just upended everything. So a very important metric that this is one you're probably very aware of. This is your program service percentage. This has sort of been the hallmark benchmark, if you want to call it that, for nonprofits for years. I know the world is trying to move away from this somewhat to look at more programmatic outcomes and impact and things like that, but that's harder to measure, and it's definitely important to note. But everyone still tends to look at program service percentage and say, how much of your dollars are being spent on your mission? And that's really what this is intended to figure out. So in short, it's the percentage of your total costs or expenses that are spent on running the organization's programs, as opposed to administration, as opposed to fundraising. So I mentioned earlier that you have a statement of functional expenses in your financial statements, and on your statement of activities, which is like your profit and loss statement or your income statement. You should see total expenses broken out by programs, management in general, which may be known as administration, and fundraising. So every organization spends money on these different areas overall. Obviously, you're exempt organizations because you're doing a greater good. Most of the money should go towards program services, right? So the higher the percentage, the more dollars are targeted to program activities. And generally speaking, the more attractive the organization may be to outside parties. Keep in mind that your financial information is publicly available. As an exempt organization, it has to be. Your 990 is reachable online. Anyone can see it. Your 990 has your program service percentage, not blatantly stated, but if anyone can do elementary math, you can take one number and divide it by the other and get your program service percentage. Your audit reports and your financial statement reviews, if you're a reviewed organization, those are available on the New York State Charities Bureau website. People don't always realize that. So I can look at your audits and easily calculate your program service percentage. Funding sources are doing this. Potential donors are doing this. Government agencies are doing this. People trying to have gotcha moments for you are doing this. So you really have to pay attention to this metric because it is important. Unfortunately, it has such importance because everyone seems to think it's that important, right? It's that type of thing. So the nature, size, and funding sources of an organization will all impact this. So we're asked questions all the time. What's a good number to have? Can't really answer that in a vacuum. Depends on the type of organization. If you're heavily government funded, you're going to have a very high program service percentage because you don't really need fundraising, or you don't have a significant level of fundraising typically. And they limit the administration that you're allowed to spend. So usually you're in the 80–85% range if you're government agencies. Our former governor tried to get every state funded organization to be at 85% or higher, which really didn't stick. It never really went into effect, and obviously he's gone now. So larger organizations, like I said, government funded health and welfare organizations tend to be higher, 75–90% range. Other organizations, if you're donation based, you tend to be lower because you have to fight very hard for your dollars. You need a significant development department. You need administration to work with donors and to create events and things like that. So just naturally, due to the nature of your operation, less money is going to the programs because more is going elsewhere. Smaller organizations may have lower numbers. Once you reach a certain inflection point, you get economies of scale, where you sort of cover your fixed costs, so additional revenue coming into the organization doesn't necessarily create expense, and you can spend more. So all of that couching just to say that if you have less than 70%, I would say be prepared to answer questions about why you're less than 70%. I think if you're in the 75–90% range, obviously 90 is a phenomenally high number. You should be good. That should be enough for satisfying potential donors and current donors and foundations and grantors and whoever else is looking at you. But I feel like once the number starts with a 6 and not a 7, people start to ask questions. So I don't think there's anything wrong with being under 70% if there's a good reason for it. So you just need to be prepared for the explanations as to why you're under that figure if you are. And this is something, again, we talk about with our boards when we present at the conclusion of our audits, and usually try to give them a bit of a speech for why it is. It's usually, we're a smaller organization, we're not government funded. We have to really coddle our donors to try to get the dollars in to keep this thing afloat. So we have higher fundraising than some other organization in some other field. So really, anyone who really knows nonprofits should realize that you can't really paint them all with the same brush. Can't compare an arts organization to a hospital. They're just totally different businesses. So that really should be the argument that's made usually for that. For others, though, if it seems too low, it might be too low. If you're in the 50s or 40%, that's very low. You should understand why that is. And if something is one clerically wrong, right? Maybe the allocation percentage between your program, your administration, your fundraising, and your financial statements is wrong. Maybe something's being done wrong from an accounting standpoint there that can easily be corrected. But if it's not that, then it could be a red flag. And you don't want red flags because then donors are not going to give to you. Because then if it's a complicated thing, the press may be looking at you. And that's when you read about these nightmare scenarios for nonprofits. They always talk about X dollars going to administration and bloated salaries and benefits that shouldn't be there. A red flag for those organizations would be this program service percentage. So make sure you're looking at that. It's the attention grabbing metric, we like to say. So definitely monitor and manage that.
So budget to actual performance. So all organizations should have some level of budgeting taking place for the future fiscal year. So typically within the first couple months of the fiscal year or prior to your fiscal year end, you want to look forward to your next fiscal year and develop some type of budget, keeping in mind any projects that are going to be taking place, expected growth or contraction, any increases in expenses for things that you might know about already, increased fixed asset costs or leases that are increasing or things like that. So it's your budgets could be either on a cash flow basis. So you're looking at the cash that you're expected to come in and the actual cash that you're going to be outlaying. So you'd exclude any non-cash items like depreciation or things like that. And you would include certain things like fixed asset purchases or other capital expenditures that would be not necessarily an expense on your financial statements, but are really a cash outflow, so you do need to consider them. Or you may also have a GAAP basis budget, which would treat capital expenditures as an asset and things like that. So there's some variation between your cash flow and your GAAP budget. I think both are useful. Your GAAP based budgets will align more closely to your financial statements and looking at your prior year financial statements and predicting out what your future financial statements will look like. Whereas your cash inflows and outflows really helps better budget on like a short-term basis if you're looking at your monthly spending and things like that. So effective budgeting is indicative of effective management of the organization overall. So really it shows that management is in tune with what is going to be happening. It gives you something to look at and to measure against. So when you're looking at your budget to actual reporting, this should be taking place on a regular basis. If not quarterly, if not monthly, then at least quarterly. Really, you should be looking at your budgeted expenditures compared to what you actually spent. And then you want to be looking at variances there. Why did those variances come to be? Were there one-time purchases, or is there kind of an overall deficiency in the budget that was prepared? You want to look at, if you're looking at your budget to actual monthly, you want to look at whether those variances are continuing each month, or if it was something that normalizes from one period to the next. There's going to be some type of, cyclical expenditures. So if you have a fundraising event in the summer, you would expect your expenses to be higher in the summer. When you're preparing your budget, are you considering that? Are you considering a monthly budget where you're factoring those things into the periods where they occur? Or are you looking at an annual budget and then dividing it by 12, because then obviously you're going to see fluctuations on your month-to-month basis if you don't have kind of like a steady revenue stream or an equal revenue stream throughout the year. If you have these one-off outlier type events, and whether if those variances are significant, if they're continuing, if they're on an ongoing basis, it might show that you weren't really effective at foreseeing or planning for future events. And it might call into question any of the forward plans of the organization if you're really not in tune with how you're spending your money and those expectations are not meeting reality.
So we're starting to wrap up here a bit. So other considerations just to talk about. Timeliness of the reports being reviewed is important. So obviously we issue audit reports and that triggers the presentations that we make that talk about all these different things that we just mentioned today. Right, but if we're reporting 9 or 10 months after year end, how useful is that information? So really what you want to do is not rely on your auditors to provide this type of information to you, but your management teams. You have to make sure you're getting timely, quality financial information. The whole point of your accounting and your finance teams is to provide you that, provide it for themselves and provide it for you as the overseers of the organization. So make sure that if you're not just relying on audit reports, you're getting information internally from management that can help you determine these benchmarks. You may want to work these into your board reporting packages, whatever they may be. Oftentimes we see that organizations are kind of lax with that and there's no formal package and they're getting rough information here and there. But remember, as fiduciaries of the organization, you're responsible for financial oversight. You may not be well-versed in financial topics, but it's in your responsibility list as board members. So take it seriously. Make sure you're trying to get information from management that is timely and accurate, and try to incorporate maybe some of these different elements and these ratios and trends and things like that into the information that you're getting, so you understand what's going on with the organization, so you can fulfill your responsibilities, ask smart questions, and help guide the organization forward. As Mahnaz mentioned, for capital-intensive projects, you have to consider budgeting for future repairs, renovations, capital improvements, things like that. Some organizations just rent and lease and it doesn't matter so much. Others have old buildings. They have organizations in the city with 100-year-old buildings, and they're always talking about the capital needs, the roof needs, and windows, and this and that. There's always something going on that requires dollars. Those capital expenditures, let's say, don't show up as expenses in your financial statements because they become capitalized, they become assets. If you put a new roof on your building, you spend $100,000, that roof will depreciate over probably 40 years, right? It's not an immediate expense, but it's immediate cash outlay. So that has to be built into this too. So the audited financial statements are not the be-all and end-all source of information that you should be looking at. You have to look at internal budgeting, cash flows, things like that to make sure that you understand what's going on as well. And building in cushions for things like that. If you have future needs that aren't liabilities in your financial statements, you should account for them when you're looking at these ratios also. Maybe add a cushion into the numbers. And for liquidity, add in $100,000 for current liabilities that you think you'll have to have, a new roof put on, using my example, things like that. It's just, you have to be somewhat flexible with what we're talking about here because every organization is different. Every organization's financial demands are different as well. So now that really concludes the planned part of this. I see I've tried to answer every question. Really, it was just Peter Desmond. Peter, thanks for the points about endowments. If anyone else has any questions or comments, feel free to share them now. What we have in the next few slides are some additional resources. I encourage everybody to look at our website. There's so much information that we produce, and we do it ourselves. So we write articles for the NFP Advisor. It's a twice-a-year newsletter that we push out. We have a nonprofit guide to effective board membership that was refreshed recently. It's our second edition. It's probably about 40 or so pages of content that's really designed just for boards. We work so much with CFOs and controllers and bookkeepers that we're sick of the accounting people. We're trying to reach out to boards and make sure that we're helping them as much as we possibly can. So that's why we have that board membership guide. We have an IT guidebook that we produced in-house. We have an IT auditor, one of our partners, who is an expert in that. And as part of our audits, we go through and dive into IT because it's a major risk area. So look for IT support and issues like that on our site as well. The nonprofit trends report for 2023, we publish this every year. Really, Ken Cerini, our founding partner, managing partner, reaches out to everybody that he knows in the nonprofit community, does some surveying and things like that, and puts together an idea list of what's relevant for 2023. So we've talked to these industry professionals, fundraising, marketing trends, operational trends, technology, and so much more is in that. You can reach that online as well. On here also, Ken will be going over that trends report. This is where we will talk about a fundraising topic that we hoped to talk about today, but obviously we ran out of time, so I'm glad we didn't include that. You can register for that. Again, Ken will be walking you through that. It's January 31st for an hour and a half. Look at our website. We do Imagine Awards for New York City and for Long Island, which is an Academy Award style presentation where we try to honor nonprofits in the community doing various different things. There's so much we do. So connect with us, stay in touch with us, and if there's anything we can ever do to help you or your organizations, feel free to reach out to us.